𝗗𝗟𝗏, the head of research and chief investment officer at Fundstrat Capital, just said, "We are watching the final phase before a massive market rebound." In this recent interview, he ties together what is happening in Bitcoin, the broader market, liquidity, and investor positioning as we head into year end. I will show you the CNBC clip he did on closing bell overtime so you can hear his take directly, and then I will unpack the key points for you in plain language. After the clip, I will explain why his view matters for both crypto and equities, where the biggest risks still lie, and how you can think about positioning if you agree with his thesis. Then I will give a detailed breakdown of 3 top AI stocks to buy right now that fit into that framework, including the case for each company, what to watch for, and how they might perform if the rebound 𝗗𝗟𝗏 describes actually arrives. If you only watch one video today, make sure you watch this one all the way to the end. Hit the like button, help us get to 1,000 likes, share the video, and leave your thoughts in the comments. Subscribe to the channel so you do not miss the next important financial investing update. Alright, let us cue the 𝗗𝗟𝗏 clip and hear what he has to say.
Tom, it's great to have you back on.
Great to see you.
So let's start right there, because we did have a bit of a bounce back here in Bitcoin and really across the crypto landscape today. But yesterday, as 𝗗𝗟𝗏𝗧 over at �11 pointed out, Bitcoin broke below its 200-day moving average. I know she's watching some technicals there pretty closely. How about you?
Yeah, I mean, I think it makes sense to watch the technicals for Bitcoin. As you know, Bitcoin is very sensitive to market liquidity and also perceptions about risk appetite and risk premia. And, over the past couple of weeks, I think there have been headwinds building, right? From the government shutdown to a hawkish Fed cut that was done last month and uncertainty about December. And as you know, with the shutdown, Treasury liquidity, the Treasury general account's actually been building cash. So I think all of these created a cascade of problems that put pressure on crypto. But hopefully, as you know, headwinds become tailwinds when you can resolve these things.
Yeah, I want to hone in for a second because I'm not sure we've been talking enough about it, but that funding stress we've seen in SOFR, I know there was data that was put out on Monday showing just a huge drop in that secured overnight financing rate on Halloween from the day before. Should we be paying closer attention to that and what that's meant in terms of the liquidity picture across asset classes?
People definitely pay attention, Morgan, because one, as you know, that can often be an early sign of stress, but it also takes place when there's window dressing. So and banks are doing window dressing at the end of month. So I am kind of watching it, but I think those funding stresses have eased. And of course, it hasn't spilled over and reflected in what should be building stress in either credit markets or in bank equities. And so I would just say that it's an anomaly, and it may be due to the shutdown. But, yeah, it's worth watching.
Okay. Just the fact that we have had this deleveraging event, if you will, in Bitcoin, I mean, what do you watch to know that that's washed out? And I guess perhaps just as importantly, has this been playing out the way it has previously in the market?
Yeah, in some ways. I mean, I think we have to go back to 2 different episodes. 2022 when FTX collapsed, and then in 2020 when we had the COVID shock. And in both cases, those were really widespread deleveraging events in crypto, because as you know, in crypto, there is typically a lot of leverage. The October 10th deleveraging was the biggest in history. And that means there are still ripple effects being felt even 2 weeks later. There has been a DeFi protocol, Streamer, that actually reported a pretty sizable loss, and that created further ripple effects. And that's what happened yesterday, along with this thing called the balancer hack. So I'd say it's probably still a couple of more weeks. The good news is there aren't a lot of bodies floating to the surface, so it doesn't feel systematic, but it's going to take some time for confidence to come back. And I think that's why crypto took it so hard in the last couple of weeks.
Got it. So what's the read-through to stocks, specifically the QQQ or the NASDAQ 100? We know there's always been this very strong, or in more recent years, a strong correlation between the two.
Yeah, and the linkages are growing because, as you know, like market makers actually trade both products. And I think in general, people get nervous because part of it is stocks have been up 6 months in a row. And we have to keep in mind that in October, we had the wobble in the first half before markets found their footing. I wouldn't be surprised if people are just pausing here and saying, look, we still have the shutdown. We've had 6 months in a row, stocks are up. markets are overbought and they get a little nervous. But let's say that that just means a wobble in the first half of November. Since 1928, okay, 100 years of data, when markets have been up 6 months in a row, 5 or 6 times you build on those gains with an average gain of 3%. And in 1936, the market was flat. I'm sorry, 1942. So in other words, you either have a flat November or actually strong. It's actually a good sign we've been up for 6 months in a row.
Okay. Given all the focus there's been on stretched valuations, particularly tied to the AI trade, do you anticipate here then into the final weeks of the year that we're going to actually start to see this broaden out a bit?
Yeah, it makes sense. I think, we are doing more Zooms with institutional investors where they're talking about not 2026. So they're trying to position. And I mean, part of me would say, I think the Mag 7 and the AI stocks are still reasonably valued because they're growing at more than double-digit growth rates. And even NVIDIA, the biggest name and most important stocks, only at 29 times forward earnings. So they're not demanding. But there are plenty of stocks that have underperformed for 3 years, where their underperformance is so severe, you haven't seen it in 50 years. And so I think there is going to be some folks looking to buy mean reverting ideas. But I'd still say I like the AI. I think there's a lot of visibility, and I think companies are starting to see payoffs. So it still makes sense to stick with it.
All right, so let's break down what Tom Lee just said in that interview, because there's a lot to unpack here. Essentially, Tom is giving us his view on what's happening with Bitcoin, the broader crypto market, and how all of this ties into stocks, liquidity, and even investor psychology as we head toward the end of the year. The interview starts with the big headline: Bitcoin bounced more than 3% after briefly dipping below $100,000 for the first time since June. That's a major psychological level for crypto investors, and naturally, everyone wants to know what it means. Tom Lee begins by pointing out that Bitcoin is extremely sensitive to liquidity and overall risk sentiment in the market. In other words, when investors get nervous when liquidity tightens, Bitcoin tends to get hit harder than most other assets. Now, over the past few weeks, he says there have been several headwinds. We've had talk of a potential government shutdown, a hawkish tone from the Federal Reserve, and uncertainty around what happens in December. Tom mentions something that often flies under the radar: the Treasury General account building up cash. When that happens, it actually pulls liquidity out of the system, and that can put pressure on risk assets like crypto. His overall message there is that all these factors combined created a cascade of pressure on Bitcoin, but as those headwinds get resolved, they could turn into tailwinds, meaning potential support for a rebound in crypto prices. Then, the conversation shifts toward funding stress, specifically what's been happening in SOFR, the Secured Overnight Financing Rate. This is an important measure of liquidity across the banking system. The interviewer brings up that there was a huge drop in SOFR around Halloween, which raised some eyebrows. Tom's take is pretty calm. He acknowledges that people should watch it because sometimes those moves can signal early signs of financial stress. But in this case, he says it's more likely related to end-of-month window dressing, where banks adjust their balance sheets temporarily. He also points out that it hasn't spilled over into credit markets or bank stocks, which suggests it's probably not a systemic issue. So, in his view, it's more of an anomaly than a warning sign. Next, they dive deeper into Bitcoin's recent volatility and what Tom calls a deleveraging event. He explains that in crypto, leverage plays a massive role. When markets move sharply, that leverage can unwind fast, and it creates ripple effects. He compares what we just saw to two previous moments: the FTX collapse in 2022 and the COVID market crash in 2020. Both of those were brutal deleveraging events that shook the entire crypto ecosystem. What makes this October 10th event unique, according to Tom, is that it was actually the biggest deleveraging in history for crypto. That's huge. And even though it's been a couple of weeks, he says the ripple effects are still being felt. He mentions a DeFi protocol called Streamer that reported major losses and another incident called the Balancer hack, which added to the pressure. The key takeaway here is that the cleanup process is ongoing. It's not over yet. The good news, in his words, is that there aren't a lot of bodies floating to the surface, meaning there's no evidence of widespread collapse or contagion. It's more of a confidence issue that will take time to rebuild. Then comes the question of how all this ties back to the stock market, specifically the Nasdaq and the QQQ. Over the past few years, Bitcoin and tech stocks have become more correlated, partly because the same institutional players are trading both. Tom acknowledges that connection and says it's natural for investors to get nervous after such a long winning streak. Stocks have been up for 6 straight months, and in his view, after a run like that, it's normal for the market to take a breather. He calls it a wobble, but he also puts that wobble into historical perspective. Since 1928, whenever the market has been up for 6 consecutive months, what typically follows is either a flat month or continued gains averaging about 3%. The only real exception was back in the early 1940s. So, his point is that the 6-month winning streak isn't a sign of danger. It's actually a good sign. It shows strength and tends to lead to more gains, not a collapse. Finally, Tom is asked about valuations and whether the market might broaden beyond just the big AI names that have dominated 2024 and 2025. His answer is interesting, because he strikes a balance between realism and optimism. He says many institutional investors are already looking ahead to 2026, which tells you they're thinking long-term. And while some people think AI stocks are overvalued, he disagrees. He argues that even companies like NVIDIA, which is one of the most important and talked about names in AI, are still trading at reasonable valuations given their growth. NVIDIA, for instance, is at 29 times forward earnings, and that's for a company growing at double-digit rates. Tom also mentions that there are plenty of other stocks, outside the AI and tech giants, that have underperformed for 3 straight years. Their underperformance, he says, is the worst we've seen in 50 years. So, as we move into the final weeks of the year, he expects investors to start rotating into those mean reversion opportunities. Stocks that could catch up after lagging behind. Still, he makes it clear that he continues to like AI because it has strong visibility, and companies are starting to see real payoff from those investments. So, putting it all together, Tom Lee's message in this interview is fairly bullish. Even though he acknowledges the short-term volatility, he sees the recent Bitcoin dip as a byproduct of temporary liquidity issues and deleveraging rather than a fundamental breakdown. He believes the funding stress we saw around 𝗖𝗢 isn't systemic, and he thinks the equity market remains in good shape historically, with the potential for further upside into year-end. For investors, the key takeaway is patience and perspective. Markets have run up for months, and some consolidation is normal, but the underlying trends, from AI innovation to recovering liquidity, are still supportive. Tom Lee's outlook, as always, leans optimistic, grounded in data, and focused on the bigger picture, rather than the noise of the moment. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into the 3 top AI stocks to buy now that could set you up for life. First up is Oracle, ticker symbol ORCL. Yes, the old tech company you might have written off, but hold on, because there's a lot more to this story than meets the eye. While most think of NVIDIA or Microsoft for AI, Oracle has quietly become a dark horse in the AI race. They've been making strategic moves that are starting to pay off in a big way. Oracle's legacy was database software, stable, profitable, but not exciting. For years, they were the go-to for enterprise database solutions, but that was about it. They were late to cloud computing, trailing AWS and Azure. Many thought they had missed the boat entirely, but founder Larry Ellison pivoted hard, investing billions into Oracle Cloud Infrastructure (OCI), designed for high-performance computing and security. This wasn't just a minor adjustment, it was a full-scale transformation. This second-generation cloud is built for the massive computing power AI models demand. Think thousands of GPUs working together at lightning speed. It's a game-changer for anyone needing serious computational muscle. Oracle's unique architecture using RDMA networking lets GPUs communicate faster and more efficiently, making AI model training cheaper and quicker. This is a significant advantage in a field where time and cost are critical. That's why top AI startups like Cohere, Adept, and even Elon Musk's xAI are building on Oracle's cloud. These companies are at the cutting edge of AI, and they've chosen Oracle for a reason. When the smartest engineers pick your platform, you know you have a technological edge. It's a strong endorsement of Oracle's capabilities. Oracle isn't just competing on price, they're winning on performance, becoming the go-to for large-scale AI training. This is a crucial differentiator in a crowded market. Their acquisition of Cerner, a healthcare IT giant, signals a bold move, using AI to revolutionize healthcare with a national anonymized health database. This could be a game-changer for the healthcare industry. This could unlock a multi-billion-dollar revenue stream in a sector desperate for innovation. The potential here is enormous. Financially, Oracle remains a cash flow machine. Their robust financial health allows them to invest heavily in new technologies without jeopardizing their stability. Their legacy business funds their cloud and AI ambitions, reducing risk. This dual approach provides a safety net while they innovate. OCI is now growing over 50% year over year, hypergrowth for a company of this size. This kind of growth is rare and highly attractive to investors. The market is catching on, but Oracle is still undervalued compared to other AI players. This presents a unique investment opportunity. The narrative is shifting, but there's still time to get in before the crowd. Early investors could see significant returns. Cloud computing is a massive market, and AI is set to explode within it. Oracle is well positioned to capture a significant share of this growth. Oracle only needs a small share for huge gains. Even a modest market share can translate into substantial revenue. Their partnership with NVIDIA gives customers access to the best GPUs, further cementing their high-performance reputation. This collaboration is a win-win for both companies. Oracle is reinventing itself, combining stability from its legacy business with explosive AI-driven growth. This transformation is both strategic and visionary. The risk isn't owning Oracle, it's waiting until everyone else catches on. By then, the opportunity might be significantly diminished. The valuation is reasonable, especially given OCI's growth prospects. This makes Oracle an attractive option for both growth and value investors. This is a long-term compounder, not a short-term trade. Investors should be prepared to hold and watch their investment grow over time. As AI transforms the economy, demand for Oracle's infrastructure will only grow. They are laying the groundwork for future technological advancements. They're building the digital foundation for the next generation of business. This is a long-term play with significant upside. While others chase obvious names, Oracle offers a blend of stability and growth that's hard to beat. It's a unique proposition in today's market. The deals they're signing are huge, multi-year commitments. This isn't speculation, it's happening now. These contracts provide long-term revenue visibility. Oracle has quietly become a major player in the AI race, with a market capitalization of $700.28 billion and earnings per share of 4.33. The company is trading at a PE of 56.73. Last year, Oracle generated $52.96 billion in revenue and $10.46 billion in net income. What is driving the stock is its new AI data platform, a product that strengthens Oracle's competitive edge in enterprise, AI, and cloud. That innovation, together with a hefty backlog of cloud and AI contracts and upbeat analyst sentiment, has helped push the stock up roughly 50% year to date. Oracle is firing on all cylinders and the story's only getting better. Don't sleep on Oracle. They are poised for a bright future. The numbers speak for themselves. Oracle's financial performance is robust and continues to improve. That's why it's my first pick for a top AI stock. Oracle is a compelling investment opportunity that combines innovation with financial strength. Next, let's talk about Advanced Micro Devices, ticker symbol AMD, a company that's gone from underdog to industry leader under CEO Dr. Lisa Su. Over the past decade, AMD has transformed itself from a struggling chip maker into a powerhouse at the forefront of the AI and high-performance computing revolution. This turnaround is one of the most impressive stories in the tech world, and it's all thanks to a relentless focus on innovation, execution, and strategic vision. AMD is now NVIDIA's only real challenger in high-end AI chips, and the market is big enough for both to thrive. While NVIDIA has long dominated the AI hardware space, AMD's rapid progress means it's no longer just a distant second, it's a true contender, with products that are winning attention from the world's largest tech companies. NVIDIA's CUDA platform gave it a huge head start, but customers want alternatives to avoid being locked in. Enterprises and cloud providers are increasingly wary of relying on a single supplier, especially as AI becomes mission-critical. This desire for choice is creating a massive opening for AMD to step in and compete. AMD's Instinct MI300 series is a legitimate competitor, matching or beating NVIDIA on some workloads. These chips are designed specifically for the most demanding AI and high-performance computing tasks, and early benchmarks show that AMD is closing the gap fast. In some cases, the MI300 even outperforms NVIDIA's best, especially in memory bandwidth and certain AI training scenarios. Demand is off the charts. AMD expects billions in sales from these chips right out of the gate. Major cloud providers and hyperscalers are lining up to get their hands on AMD's latest hardware, and the company is ramping up production to meet this unprecedented interest. This surge in demand is a testament to how much the industry wants a viable alternative to NVIDIA. AMD is also investing in its open-source software ecosystem, ROCm, encouraging a broader developer community. By making its software stack open and accessible, AMD is lowering the barriers for developers to adopt its hardware. This is a crucial move, as software compatibility and developer support are often the deciding factors in large-scale AI deployments. Major cloud providers are helping ensure AI frameworks run smoothly on AMD hardware, giving customers more choice and leverage. Companies like Microsoft, Google, and Amazon are actively working to optimize their AI services for AMD chips, which means customers can now run their most advanced workloads on either platform with minimal friction. Beyond AI, AMD's 𝗗𝗚𝗧 server CPUs are taking market share from Intel, powering the world's largest data centers. These chips are known for their high core counts, energy efficiency, and performance, making them the go-to choice for cloud computing, enterprise workloads, and supercomputing projects around the globe. Their acquisition of Xilinx adds FPGAs, programmable chips ideal for AI at the edge, to their portfolio. FPGAs are incredibly flexible and can be customized for specific AI tasks, making them perfect for applications like autonomous vehicles, robotics, and industrial automation. Now, AMD can offer customers a full suite: CPUs, AI GPUs, and FPGAs, a one-stop shop for high-performance computing. This breadth of products allows AMD to serve a wide range of customers, from cloud giants to startups, and positions the company as a key enabler of the next wave of digital transformation. Financially, AMD is growing revenue fast and expanding margins, funding R&D for its AI push. The company's strong balance sheet and disciplined management mean it can invest aggressively in new technologies while still delivering value to shareholders. The AI chip market is projected to be worth hundreds of billions in the next few years. If AMD captures even a fraction, the upside is massive. The sheer scale of this opportunity is hard to overstate. AI is reshaping every industry, and the demand for compute power is only accelerating. Risks remain. NVIDIA is a fierce competitor and software is a tough battle, but demand for AI chips is so high that customers are eager for alternatives. The competitive landscape is intense and AMD will need to keep innovating to maintain its momentum, but the company's recent track record suggests it's up to the challenge. Think of it like Coke and Pepsi, both thrive in a huge market, and AMD is becoming the Pepsi of AI chips. In a world where there's room for more than one winner, AMD's growing presence ensures healthy competition and better outcomes for customers. The stock's valuation doesn't fully reflect its potential to be a major player in the space. As the market wakes up to AMD's progress in AI and data centers, there's significant room for upside in the share price. Every dip is a buying opportunity for long-term investors. For those with patience and conviction, these moments of volatility can be the best times to build a position in a company with AMD's growth prospects. The world needs more compute for AI, and AMD is one of only two companies that can deliver at the highest level. As AI models become more complex and data-hungry, the need for advanced chips will only grow, and AMD is perfectly positioned to meet that demand. Dr. Lisa Su's leadership is a huge asset. She's a top-tier CEO and strategist. Her technical expertise and business acumen have guided AMD through some of its toughest years, and her vision continues to drive the company's success. Betting on AMD is betting on her continued execution. Few leaders in tech have delivered such a dramatic turnaround, and her track record inspires confidence in AMD's future. The bull case: competitive AI chips, open software, massive demand, strong customer relationships, and a broader product portfolio. AMD's unique combination of hardware, software, and partnerships gives it a durable edge in a rapidly evolving market. AMD is no longer the underdog. They're a true peer to the industry's biggest names. The company's achievements have earned it a seat at the table with the world's most influential tech giants. The AI story is just beginning, and the next few years could see explosive growth as their chips ramp up. As more companies adopt AI and demand for compute skyrockets, AMD's role in powering this transformation will only become more critical. That's why AMD is my second pick. It's a company with momentum, vision, and the right products at the right time. The risk-bought reward is highly attractive for investors with a multi-year view. If you're looking for exposure to the AI boom beyond NVIDIA, AMD is a compelling choice. AMD's transformation into a diversified, high-performance computing powerhouse is well underway. The company's ability to innovate and execute across multiple product lines sets it apart from the competition. The AI chapter is set to be the most exciting yet. With new products, expanding partnerships, and a surging market, AMD's future looks brighter than ever. Don't overlook AMD's role in the AI revolution. As the world races to build smarter machines and more powerful data centers, AMD is right at the heart of the action. AMD now sits at a market cap of $394.26 billion, reports EPS of 1.92, and is trading at a PE of 125.97. Revenue in 2024 came in at $25.78 billion with net income around $1.64 billion. The company posted an impressive 72% surge in earnings and continues to widen its market share against legacy incumbents. Even as broader tech valuations have come under pressure, recent partnerships and strong revenue guidance keep the bullish thesis intact. Their momentum is real, and the opportunity is enormous. The next wave of AI innovation will be built on the kind of technology AMD is delivering today. This is a company to watch closely. As the AI landscape evolves, AMD's progress will be one of the most important stories to follow. AMD is my second top AI stock, and I believe its best days are still ahead. Finally, let's talk about the company at the very heart of the global AI supply chain, Taiwan Semiconductor Manufacturing Company, better known as TSMC, ticker symbol TSM. If you use a smartphone, a laptop, or any device powered by advanced chips, there's a good chance TSMC played a crucial role in making it possible. TSMC is the world's leading chip manufacturer, producing the most advanced and powerful chips for industry giants like Apple, Nvidia, AMD, and countless others. Their chips are the invisible engines driving everything from iPhones to data centers to the latest AI breakthroughs. Unlike companies that design chips, TSMC specializes in building them. They operate massive, state-of-the-art factories called fabs, where precision and cleanliness are taken to an extreme. These fabs are among the most advanced manufacturing facilities on the planet, filled with cutting-edge equipment and highly skilled workers. TSMC is years ahead of competitors like Samsung and Intel when it comes to manufacturing technology. Their relentless focus on innovation and efficiency has created a powerful moat, making it nearly impossible for rivals to catch up in the race for smaller, faster, and more energy-efficient chips. If you want the fastest, most efficient chips for AI, you have to go to TSMC. Their expertise in producing chips at the tiniest nanometer scale means they're the only game in town for companies pushing the boundaries of artificial intelligence and high-performance computing. They have a near monopoly on leading-edge chip production, controlling over 90% of the world's most advanced chip manufacturing capacity. This dominance gives them enormous pricing power and influence over the entire tech ecosystem. TSMC is the ultimate picks and shovels play for the AI gold rush. It doesn't matter who wins the chip design race, whether it's Nvidia, AMD, or a new startup, TSMC profits from all of them because everyone needs their manufacturing expertise. Building a new fab is a monumental undertaking, costing billions of dollars and taking years to complete. These huge barriers to entry protect TSMC's dominance and make it extremely difficult for new competitors to emerge. Their massive scale allows them to run their fabs at high utilization rates, driving down costs and boosting profitability. This efficiency is a key reason why TSMC can consistently deliver strong financial results, even in a cyclical industry. AI models, especially the most advanced ones, require the latest and greatest chips. Every major player in the AI space, whether it's for training massive language models or powering autonomous vehicles, relies on TSMC to deliver the hardware that makes it all possible. As demand for AI chips explodes, TSMC is the direct beneficiary. The more the world leans into AI, the more essential TSMC becomes, and the more their order books fill up. In fact, TSMC is the bottleneck in the AI supply chain. The pace of AI progress worldwide depends on how quickly TSMC can produce and deliver chips. If TSMC slows down, the entire industry feels it. The main risk to TSMC is geopolitical. Most of their advanced fabs are located in Taiwan, which sits uncomfortably close to China. This proximity raises concerns about potential conflict and supply chain disruptions. TSMC is actively addressing these risks by building new fabs in the US, Japan, and Germany. By diversifying their manufacturing footprint, they're making the global chip supply chain more resilient and less vulnerable to regional instability. Their global importance acts as a silicon shield, discouraging conflict and encouraging cooperation among world powers. TSMC's role is so vital that it's become a strategic asset for multiple countries. Financially, TSMC is a model of consistency, delivering steady growth, high margins, and a growing dividend year after year. Their financial discipline and operational excellence set them apart in the tech world. Despite its dominance and critical role, TSMC trades at a discount compared to other tech giants, mainly due to geopolitical fears. For long-term investors, this presents a rare value opportunity in a sector usually known for sky-high valuations. As new fabs come online and global demand for AI and advanced chips continues to surge, the market could re-rate TSMC's stock much higher, rewarding patient investors. Investing in TSMC is essentially a broad bet on the future of technology. Faster phones, smarter cars, more powerful AI, and innovations we haven't even imagined yet. Their chips are the foundation for tomorrow's breakthroughs. All those trends, AI, 5G, cloud computing and more, flow directly to TSMC's bottom line, fueling their growth and reinforcing their leadership. For anyone building a tech-focused portfolio, TSMC is the ultimate foundational investment. It's the company that quietly powers the entire digital world. Their near-monopolistic position, indispensable role in AI, strong financials, and surprisingly low valuation make TSMC a compelling pick for both growth and value investors. TSMC is the quiet enabler behind the AI revolution, working behind the scenes to make the impossible possible. That's why it's my third and final pick for the best AI investments right now. Don't underestimate the company powering the entire industry. TSMC's influence stretches across every corner of the tech landscape. TSMC carries a market cap of approximately $1.51 trillion and reported earnings per share of 9.01 in Taiwan dollars, with a PE near 32.35 on that same basis. Fiscal 2024 revenue was 2.89 trillion Taiwan dollars, and net income was about 1.15 trillion Taiwan dollars. The company delivered revenue growth of 24.27% and earnings growth of 26.99%, supported by exceptionally healthy margins. Gross margin sits near 56.29% and operating margin around 45.81%, which speaks to both pricing power and cost discipline. The stock trades at a premium, reflecting a PE around 27 times on one commonly cited measure, and that premium shows investor confidence in TSMC's role in future semiconductor expansion despite the higher valuation. TSMC is truly the backbone of the AI era, supporting the innovations that will define the next decade and beyond. For any investor looking to capture the future of technology, TSMC is a must-watch stock, one that deserves a place on your radar. So, there you have it. 3 companies critical to the AI revolution, each playing a unique role. Oracle is reinventing cloud infrastructure, AMD is challenging the AI chip leader, and TSMC is the essential manufacturer behind it all. If you want to learn my full framework for finding stocks like these, check out my Value Stocks Investing Master Course, link in the description. Huge thanks to my Patreon supporters for making these deep dives possible. Now I want to hear from you, of Oracle, AMD, and TSMC, which has the most upside over the next 5 years. Drop your thoughts in the comments. If you got value from this video, smash that like button and subscribe for more. Thanks for watching. I'll see you in the next one.